If you have been struggling to figure out the best way to catch trend reversals, then this is the right video for you. Well, trend trading is arguably the most profitable style of trading. You flow with the institutional momentum with low stop-out risks and infinite upside potential. But the bitter truth is that the market will reverse at some point, and if you are a trend trader, the market will flip on you, and you will take a loss at the zone of reversal. But what if we can see early signs of reversal so that rather than continuing to take losses, we can take advantage of the new direction of the market? We can take early entry at the beginning of the new trend for massive profits. In today's episode, I will walk you step by step through a powerful reversal trading technique that combines smart money concepts with Rsi divergence. This strategy turned around my trading journey that I wish I knew when I started trading. Here is what we will cover. The basics of RSI indicator. The meaning of Rsi divergence. Rsi divergence confluences with other smart money concepts. Well, if that's something you are interested in, make sure you hit the like button to help us make more videos like this. Please subscribe to our channel if you are new, since we publish many advanced trading concepts. Let's get into it. So, what is the RSI indicator? The Relative Strength Index indicator is a technical analysis tool. It measures the speed and magnitude of price changes to determine if an asset is overbought or oversold. It helps traders to identify potential trend reversal zones and price overbought or oversold levels in the market. To add this indicator on your chart, click the Indicator tab on the TradingView platform. In the search bar, type RSI. A list of indicators will pop up. Then click on the Relative Strength Index and it will be applied to your chart. You can retain the default settings. The Relative Price Index has two matrix levels of 70 and 30. When the RSI rises above the 70 line, it implies that the asset may be overbought. It shows that the asset prices has made significant gain over a limited period of time. As a result, it suggests that price may reverse or price correction may occur in the near future. Conversely, if the RSI falls below the 30 line, it may indicate that the asset is oversold. This may imply that price has decreased significantly over a limited period of time, such that price reversal or correction may occur soon. Point to note here is that we should never use the RSI indicator alone as a signal to buy or sell the market. Price can sometimes stay in the overbought or oversold conditions for a long period of time. Entering the market solely with the RSI indicator overbought or oversold can often lead to significant losses. So how best do we use the RSI indicator? The most effective technique to apply the RSI indicator is to use the RSI divergence between the price and the RSI indicator. This inconsistency between the price of the asset and the RSI indicator can be an early sign of potential trend reversal. So, what is RSI divergence? The RSI divergence is a signal in technical analysis that occurs when the price of an asset and the relative strength index indicator are moving in opposite directions. This inconsistency between the price and the RSI indicator shows that the market momentum is not confirming the current price trend, suggesting a trend exhaustion or a potential trend reversal. You see, the RSI is designed such that it should be in sync with the price direction. When price makes lower lows in a downtrending market, the RSI should also print lower lows. When price makes lower lows and the RSI make higher lows, this indicates a bullish divergence. It shows a disconnect between price and the RSI, pointing trend exhaustion and possible trend reversal. Conversely, when price prints higher lows in a bullish market, the RSI should mimic the same pattern. But if the RSI prints lower lows, this results into a bearish divergence. This shows loss of momentum in the bulls, signaling trend exhaustion or possible trend reversal. Let's take a look at this example. In the chart, price is making lower lows while looking at the RSI, it is printing higher lows. This led to this bullish trend reversal. This concept can also be seen in this uptrend. Price has made higher lows while the RSI is printing lower lows. This divergence led to the bearish reversal of the market. Before we continue, traders, if you have come this far, please support us by giving this video a thumbs up and subscribe if you are new to this channel. Let's now combine RSI divergence with smart money concepts to construct a high-probability trading model. First, we combine RSI divergence with market structure shift at a key supply or demand zone for solid confirmation. Here, we have AUD-USD chart. In this higher time frame, we are looking at a bullish market that consistently breaks structure to the upside. Our overall higher time frame bias is bullish. But we don't just buy in the middle of nowhere. We identify the optimal buying zone, which in this case will be this demand zone. If the market pulls back to this zone, we zoom into the lower time frame for buying opportunities. The market has tapped into this key demand zone. Here in the lower time frame, we wait for the market to show us reversal signs in this short-term downtrend to open doors for bullish continuation. Looking at the RSI indicator, we can see that there is a bullish divergence as the market has made lower lows while the RSI has printed higher lows. This is the first sign of trend reversal happening at a key higher time frame level. This weakness in sellers is also confirmed by the market structure shift. The bulls have taken control, bringing an end to the short-term downtrend. You can see the RSI divergence and the market structure shift at a key demand zone, which led to the market reversing to the upside. Let's look at a bear's scenario. We have the AUD-USD chart. Here in the higher time frame, the market is bearish, printing lower highs and lower lows. Our overall bias is bearish. We can see that the market swept liquidity before breaking structure to the downside. The latest bearish leg also created a fair value gap, strengthening our setup. This supply area forms our optimal selling zone. If the price pulls back to the supply zone, we zoom into the lower time frame for sell confirmations. Here in the lower time frame, if we look at the price and the RSI, we have a bearish divergence. This is the first sign of trend reversal. We don't enter short immediately as the price may stall and continue to the upside. Our second confirmation is to wait for the price to break the latest higher low to confirm market structure shift. It's then that we look for sell opportunities. We can see the price tapped into this lower time frame order block and sold off. But traders, remember to do your own back testing to optimize this trading model. The second RSI confluence is to combine RSI divergence with liquidity sweep of key market structure point. Let's look at a bearish example. Here we have a bearish market in the higher time frame. The market has pulled back and swept this recent structure high and closed within the range. This shows liquidity grab. We zoom into the lower time frame for sell confirmations. Here in the lower time frame, price has made higher highs while the RSI has printed lower highs. This shows bearish divergence. We now wait for the market to break this recent structure low to confirm market structure shift. You can see that the market sold off aggressively as anticipated by our model. In a bullish market, we identify a key market structure point that has a liquidity pool. When the market pulls back and sweeps the liquidity, the market must close back into the range as can be seen in this chart. We now zoom into the lower time frame for signs of reversal. Here in the lower time frame, we can see this beautiful RSI divergence. We wait for our extra confirmation, which will be the break of this recent structure high to confirm market structure shift. Now that there is a change of character, it indicates that the buying pressure is back in the market. You can see the power of this model as the market expanded aggressively to the upside. So traders, I hope you found value in this video. Please give this video a thumbs up and support us by subscribing if you are new. Let us know your experience in trading reversals.